Hey everybody, Ben Larson here, co-owner and real estate advisor with Engel and Völkers South Bay. And today I'm here with Michelle Malura, senior loan advisor and branch manager with RPM Mortgage. Michelle has over 20 years of experience in lending in the financing world, and I've been working with her for over 10 years. Lots of experience, very knowledgeable, and so wanted to bring her on today to tell us a little bit about what's going on and go over some specific questions. So thanks for joining us here today, Michelle.
Oh, my pleasure. Thanks for having
All right. Yeah, of course. It's important information. I want to get it out to everybody. So first, I wanted to talk about forbearance. There's a lot of unemployment. There's a lot of people that are, maybe having problems making their mortgage payment right now, and it's unfortunate. I personally know people that are going through that. And can you just tell us a little bit about first, what is forbearance?
Absolutely. So, and I do think, I'm glad you're bringing this up because I think there is a lot of misinformation out there or lack of information about exactly what it is. But forbearance is something that came through the CARES Act, which is the COVID Relief Act. And two things that they came out with to help homeowners during this pandemic is they put a 60-day moratorium on foreclosures starting in March, middle of March. And then the second thing, which is what you're asking about, is mortgage forbearance. So it's important to know that mortgage forbearance is not forgiveness of mortgage owed. It is just the ability to either delay or partially suspend part of your mortgage payments for a period of time if you are being negatively impacted by the COVID-19 pandemic. And it's not that you don't accrue the interest you owe. It's not that those payments don't have to be made. Those payments will have to be made to your lender. So what we are strongly encouraging people right now is that if you can make your mortgage payments, you should. This is truly something designed to help those people that are genuinely financially impacted by the pandemic and don't have the means to make their mortgage payments at this particular moment because of loss of job or, however they were impacted. So what it is if your mortgage is federally insured, meaning it's owned by either FHA, VA, USDA, Fannie Mae, or Freddie Mac, you have the ability to request a mortgage forbearance program. And what will happen is you have to reach out directly to the servicer of your loan. So that is the company that sends you your monthly statements. That is who is servicing your loan. So they will be the ones to manage the mortgage forbearance application process. So you need to reach out to them. What I've noticed, what I'm seeing is that most loan servicers already have information on their websites on how you can apply. They're being pretty proactive about allowing people to know what to do. And you apply, you explain why you're in need of mortgage forbearance, and then based on their review of your application, they will approve you. So you can request to either suspend or reduce your required mortgage payments for 180 days. And you will have the ability, if you need to, request a secondary 180-day extension. But what's really important for people to know is their servicer is going to approve them for what they qualify for. So it could be that they don't have to make any payments for 180 days. It could mean that they have to make partial payments for 180 days. But the really important question, Ben, that they need to be asking is, what is going to be expected of them for repayment? So are they going to have to repay the entire deferred amount at the end of the 180 days? Is the lender going to allow them to spread out the repayment over the next 12 months? Perhaps the lender might let them add the lump sum onto the back end of the loan. And I've even heard that some lenders may even be allowing people to extend the term of their loan at the back end to tack on those payments that were missed. But you can't be making any assumptions right now about what options will be presented to you. You really need to ask those questions because it's important to know how you are going to repay those deferred payments.
Right. Yeah, that's a great point. I didn't think about all the different ways it could be done. How will it impact people's credit if they do forbearance? Is that something that's going to negatively impact their credit?
Well, it shouldn't. I say shouldn't because I'm always a little weary when these kinds of programs come out very quickly in how they are fully executed down the road. Because, you know, I lived through this in 2007 in the last recession where loan modifications weren't supposed to be reported on credit and there was a lot of promises made, but we saw that those things did many times get reported on people's credit as derogatory credit. So what they're saying is that if you applied for mortgage forbearance and were approved by your loan servicer, it will not negatively impact your credit rating. You will not be charged any penalties for the payments you missed. You will be charged your accrued interest owed, but no other penalty type of additional interest will be charged. So that's what they're saying. But I think the key thing within that is an approved mortgage forbearance. I'm concerned that a lot of people are just making the assumption that they can stop paying their mortgage and are not going through the proper steps of applying with their loan servicer and getting approved for this. And if you skip over those steps, more than likely you are going to have derogatory credit reporting against you for late payment. So it's really important to follow the steps. We are being told it will not negatively report on your credit. I think time will tell how that all really plays itself out.
So that just goes to your point of keep making your payments if you can, because they're saying it won't impact your credit, but who knows? And if you don't want to take that risk, then it's not worth it.
Well, and I want to point out, I think there's a few downsides to doing mortgage forbearance if you didn't really need to do it. Number one, I do believe you are taking a risk of how that's going to report on your credit down the road. That's my personal opinion.
Right.
Number two, you are impacting the principal payments you've made into your home. So that's affecting the equity you build in your home if you stop making payments. Number three, rates are really, really good right now. It's an incredible time to be looking at refinancing into a lower rate. But if you have applied for mortgage forbearance or you have stopped making your mortgage payments, you are not going to qualify for a refinance. So you can end up essentially kind of shooting yourself in the foot. And you'd be surprised. I've had several clients call me saying, I want to refi, I want to get into a lower rate. Oh, and by the way, I'm going to apply for mortgage forbearance too, simultaneously. So that is not going to work. If you've applied for mortgage forbearance, you are basically telling the lender you do not have the ability to make your mortgage payment. So one of the key qualifying factors in applying for a mortgage is you are stating that you do have the ability to repay your mortgage. So those two things are contrary to one another.
So, a couple of other things that come up on forbearance from what you mentioned, how would someone know if their mortgage is federally insured?
Well, there's a couple of lookup tools you can use. Fannie Mae and Freddie Mac both have a lookup tool online where you punch in your information and it will tell you if your loan is owned by Fannie or Freddie. So the Fannie Mae website is www.knowyouroptions.com/loan lookup all together. And Freddie Mac's is www.freddiemac.com/loan lookup/.
Okay, great. And so what about if someone, if they go and they check those sites and they find out their loan actually is not federally insured?
Well, those folks may still be eligible for mortgage forbearance. So what they need to do is they need to reach out again to the person who mails them their monthly mortgage statement each month. There should be a customer service number or an online website they can log into. My understanding, and from what I've heard from colleagues and clients, is most banks are offering some type of mortgage forbearance plan for their clients. So even if your loan is not owned by Fannie or Freddie or FHA, VA, or USDA, more than likely there will be an option for you as well to apply for mortgage forbearance.
Give us a little information on, lending guidelines. We're hearing a lot. There's a lot of headlines about what's going on. Things are changing. Things are getting stricter. Can you give us a little bit of info on, what are maybe some of the biggest changes and, that most people need to know about and that may affect anyone that's looking to buy or even refinance? Like you mentioned, rates are great. A lot of people are looking to refi right now. So what have you heard about that?
Well, I'm in a unique position because we are a mortgage bank and we have many, tens of lenders that we work with. So I'm getting to see what's happening across the board with many, many different lenders. And we've seen a lot of changes. We get guideline changes almost daily. So one of the big things that has changed for most lenders, and it's not for every transaction and it's not for every lender, but the majority of the lenders right now, if you are purchasing a home, they are allowing for exterior inspections only on the appraisals. So they're no longer requiring for the appraiser to enter into the property and do an interior physical inspection. That was something that took a couple weeks to happen when COVID-19 started. Didn't happen overnight, but for the most part, most lenders right now are trying to comply with the social distancing and not putting anybody at risk. So that's been one major guideline change. Now, again, it's not for every lender and it's not for every type of loan, but I would say the majority now. For the most part, we have seen things retract from a guideline standpoint. They've gotten more stringent. So some examples of that, we've had many lenders come out and increase minimum credit score requirements now for qualifying. We have had lenders come out and increase their post-close reserve requirement guidelines, meaning how much liquidity the buyer has after close of escrow. And they've brought all their money to the closing table. What do they have left over? We've seen those requirements increase. They've either increased or they've made them more stringent by eliminating certain retirement accounts that we used to be able to use to meet those requirements. We have seen loan to value guidelines get stricter. What else? We have just seen loan programs eliminated entirely. So most lenders right now have eliminated cash out refinances where you refi to pull equity out of your home. They're still available. We still have some available, but many are no longer offering that type of loan. And everybody could eventually follow suit. It's changing every day. So yeah, I mean, I would say in general, things have gotten a little more restrictive and they've kind of elevated the requirements for qualifying for a mortgage, right, particularly in the jumbo world. The conforming world is maintaining pretty steady, but in the jumbo world, which is depending on the county you live in, for LA County, those are loans over $765,000. That's where we've really seen things tighten up.
Okay, good. Yeah, that was going to be a question, is what specifically is a jumbo loan? So I'm glad you mentioned that. And so just a little bit about you and RPM, you hear a lot about some lenders and banks are, they're really raising their credit requirements, 700 and above, or, nothing less than 20% down. Do you have loan programs that are a little looser than that don't have those strict qualifications that they're changing?
Well, in the jumbo lending world, we are not seeing lenders doing 10% down anymore. That's pretty much gone. But fortunately, we still have second trustee lenders that are willing to do piggyback line of credits. So right now, I still have home equity line of credit banks that will go to 89.99%. So we're still able to get a 10% down purchase done, but we're having to structure it a little bit differently. The way we used to have more options on how we could structure those loans, and now we are back to being more limited to a 2-loan structure.
Okay. Well, it's great you get the option of getting it done. Is there, specifically on the jumbo loan world, since that's a lot of what we deal with here locally, what options are there if they do put 20% down? You still have lenders that will do jumbo loans?
Correct, we do. We have lenders that will still do 20% down jumbo loans. Of course, like I mentioned earlier, some of the reserve requirements have been elevated at some banks. A few of our banks are still holding on to their original guidelines, and these were lenders that were already a little more conservative, so they haven't yet felt the need to become more conservative. But yes, as long as you can meet the credit requirement, the post-closing reserve requirement, and as long as your income is stable, I think that's a big thing to talk about right now. The lenders are being very cautious in evaluating income and the sustainability of income. So if you are somebody that has lost their job or has been put on, extended furlough, you are not going to qualify for a loan right now. You do have to be actively working, actively getting paid. If you're your own business owner, which, as you know, Ben, we deal with a lot of entrepreneurs in LA County. I would say probably half of my clients are self-employed. They are going to be looking at how your business has been impacted by COVID-19. They're going to look to make sure you're still open, that you are still generating revenue. A lot of businesses that were not considered essential were forced to close down. Recently, this didn't happen to one of my clients, but recently within my company, we had a self-employed borrower who was in the middle of getting a loan. They were in contract and they had to shut down for COVID-19, and they updated their website. And on their website, they wrote like, we're not accepting new business or closed due to the quarantine. I don't know what the exact language was, but they publicly put a note up on their website, and that was an immediate decline on their loan because the underwriters will look up self-employed borrowers' websites, and they saw that, and it was an immediate decline. So, you do have to still be open, operational. Typically, like right now is a perfect example. Typically, if you're self-employed and you hadn't filed your 2019 tax return yet, in the past, we would just require a year-to-date P&L of the prior year. And then if we, like right now, we would typically just require first quarter P&L of 2020. What a lot of lenders are doing now is they're also requiring the most recent month P&L for self-employed borrowers, because they do want to see that you are still generating revenue. This has not shut your business down.
Good to know. It's a lot of really good information. Before we go, I want you to just, if you can, touch on rates a little bit. And, I'll give a disclaimer. We know those change. We know it varies from person to person on their situation or the loan program. And I like to give the date because all information that you just talked about could change. So, we're talking this year on April 18th, 2020. A few days from now, it could be different. The way things are changing all the time right now. But that's great info. Thank you. Yeah, if you could just give us a general ballpark on, some of the more common loan programs and where rates are at this point.
Absolutely. So rates are great. I mean, rates have been holding steady and they've been low. They are, I would say, in the jumbo world, you're going to probably be somewhere in the mid 3% to upper 3% range for a 30-year fixed. In the conforming world, you're going to be in the lower 3% range, and probably anywhere between 3 to 3.5% range. The 15-year fixed conforming is in the twos, 2.5 to 2.75 range. Again, to your point, so many things impact the interest rate that you're offered. Many things are taken into consideration. So this is just kind of a general range of where we've seen rates. The rates have been very, very volatile. We are getting midday rate changes almost every day. That's pretty unusual. Typically, those only happen once in a blue moon if there was a really drastic change in the bond market or the stock market, or something kind of really out of the norm happened economically. Right now, we are getting midday rate changes fairly regularly just because of the volatility, and everyone is proceeding with a lot of caution. The banks are. And so I've had many instances where I've quoted somebody in the morning, and by the time they email me back at 4 o'clock to lock, it's changed. So I've got to go back to them and say, well, things changed since I sent you that email. So sometimes they change for the better, sometimes they change for the worse. VA loans right now and FHA loans are a little bit tricky. I've been having to really work closely with my VA clients right now because we are still doing VA loans and the rates are good. They're in the mid 3 to upper 3% range, and you can go lower than that. But what's been interesting with VA loans is, generally speaking, in the past, when you get a VA loan, you're looking at 0-point loans, because the whole idea of a VA loan is that you're coming in with no money down.
Right.
The buyer usually doesn't have a ton of liquidity. And so we're trying to keep their closing costs to a minimum. Right now, they're, within my company at least, and I don't want to speak for the whole world, but I have heard from colleagues that this is across the board. There's no like 0-point VA rates. The veterans are having to buy down, pay discount points on their rate. And the way we've been dealing with that challenge is we've been having to write offers where the seller is going to credit towards closing costs so that we can offset those fees with a seller credit.
That's a good idea.
So it's just, we're having to kind of pivot a little bit and navigate these new waters on how to still get our clients into homes, but it might look a little bit different than it looked a month ago. But rates are very good in general, and I highly recommend that if you have a mortgage, at the very least, you should be reaching out and just seeing if you would benefit from a refi. Worst case is that you're told no, and you keep the mortgage you're in.
Okay. Well, great. Well, as always, Michelle, really appreciate the information. You're a wealth of knowledge on this topic. So thank you for taking the time. Out there, if you have any questions about mortgages, financing, real estate, whatever it may be, however you're watching this, if it's on social media or YouTube or as an email that someone forwarded you, reach out. Just make a comment, direct message, send an email, reach out, and we're happy to answer any questions you may have. So, Michelle, any last comments before we wrap up?
No, just thank you for having me. And like you said, it's changing every day. So it's really important to keep high levels of communication and just make sure you're up to date with everything that's happening if you're in the middle of a purchase or a refi.
Great. Well, thanks again. All right. Have a good day, everybody. Stay safe.